I'm gonna go over I have five medical REITs for you that I'm gonna tell you guys about. As you know, a REIT is a real estate investment trust, and typically they have really high dividend yield. And see this one I have pulled up here. The first one here, Omega Healthcare Investors, has 8 point dividend payout rate yield of 8.33%. Average volume of 2.29 million, which isn't bad. Market cap of 7.3 billion, and it says Omega Healthcare engages in the provision of financing and capital for the long-term healthcare industry with a focus on skilled nursing facilities. So this would be like your nursing homes and your stuff like that. You can see it's still down. It was trading 36 up to 42, 43 here before coronavirus, and it's still down 11% on the year. So it's still relatively low priced. You can still catch in on hopefully some upside. It's 5-year graph. Looks like it was down here a little bit between 2015 and 2018, and then started going up from there, obviously until coronavirus. Um, but this one I'm look at has 50% buy rating, 40% hold, 10% sell, and earnings tend to be looks like around 79% or 79 cents per share, which isn't bad. On a 35-cent stock, that's or $35 stock, that's not bad. My next one here, GMRE Global Medical REIT. It's only $11.94, so it's pretty cheap dollar wise. But it's had dividend yield of 6.56%. But one thing I do like about this, at least just looking at it at a glance, it does have a buy rating of the analysts have a buy rating of 100%. So 6 analysts have given this all a buy rating. Now I don't know anything about the analysts that gave it that. I could give it a buy rating, but that doesn't legitimize the rating. So you'd have to look into that. Earnings tend to be 15 to 20 cents on average. Come here, it is up, which I guess is good. It takes you back to pretty much it's up 10%, 9.5% from June 18th. So before coronavirus, it was up at 15. Now it's at 11.94. It's 5-year. Looks like it IPO'd here in 2016 at, or I don't know if it IPO'd or what, it was trading at 15 cents. But then it shot up. I don't know what happened, but it jumped up to $12 or $10, and it's still there. 12 to $15. But one thing I do not like about this is I always talk about the payout ratio and how that basically tells you if the dividend that they currently pay is sustainable. They have a dividend payout ratio of 1,882%, which is not good. A dividend payout ratio of 100% means they're paying out 100% of the money they earn back to the shareholders in the form of dividends. So they're not keeping any money for any more acquisition costs or anything like that. So any payout ratio higher of 100% means that they are either taking out loans or going into debt or draining their cash on hand to pay those dividends, which just means it's not sustainable. Either they're going to have to cut dividends, or or the share price might go down. Let me X out of that one. But just another one to look out for. Next one here is Physicians. This is number 3. Physicians Realty Trust, real estate investment trust, which engages in the acquisition, development, owning, and managing of healthcare properties. That's one thing I do like about this one, is that it does talk about them managing it and developing them instead of just financing and building. Market cap of $3 billion, so it's pretty big. Dividend yield of 5%, 63% buy rating, and earnings tend to be between probably 20 to 28 cents. Let's go to the 1-year graph. Trends up, at least until coronavirus, obviously, but everything went down then. Trends up. It's still up 0.5% on the year. and its 5-year graph tends to be up and down, but also kind of steady. It's not like you have consistently higher highs and lower lows. Um, so I think it looks, at least here, like it's going to be pretty steady. You're not going to make any money in the appreciation of the stock, but you will make 5% on your dividends, and a PE ratio of 45%, which is good. I could not find the. Also didn't look very hard. I only looked on dividend.com. I'm sure you could find it if you dug into it and looked into it a little bit more than I did, but I couldn't find the payout ratio. Um, I only looked on dividend.com, but I also like to use Yahoo Finance. They have a lot of information on there. But let's move on over to number 4, healthcare, Realty Trust, 3164 right now. Its 1-year graph is down almost 3%. 5-year is up 34.7%. So on the 5-year, it'll go up, down, up, back down, and then up. So it looks like if it continues that trend, it looks like it'll keep going up. But also called Healthcare Realty Trust, is a real estate investment trust. Owns, leases, manages, acquires, finances, develops, and redevelops income-producing real estate properties associated primarily with the delivery of outpatient healthcare services. So it sounds really good. They do it. They do it all. They purchase, manage, lease, own, finance, develop, redevelop. They do it all. Dividend yield of 3.8, so not as high as the others. Price to earnings ratio is a little high of 113. So that pretty much means you're paying $113 for every dollar of future earnings. Again, I didn't really look for the payout ratio other than dividend.com, and it was not on there. But they have their earnings here of about 45 cents per quarter, and only a 23% buy rating, but a 77% hold rating, which isn't terrible. And let me move on to the last one here. This is one I've actually been looking at for a while. I just haven't pulled the trigger and actually bought it yet. But Cardinal Health, it's trading at 53.66 right now. It's up 20% on the year, which is impressive. Down consistently though in the 5-year graph. 5 years ago it was up at 86, and now it's back down. They're hop over here to dividend.com. They have a payout ratio of 36.9%, so they are maintaining, or keeping all that cash. I don't know what the problem is with the declining stock value. I don't know if they're making too many acquisitions, and that's what a problem with General Electric had several years ago, is they were just making too many acquisitions in areas that they were not, experts in, and so because of that, they acquired too much debt, and it just tanked their stock value. So I don't know if it's something like that or what it is, but down 39.5% in the past 5 years. But Cardinal Health is a health engaged in the provision of customized solutions for hospitals, healthcare systems, pharmacies, ambulatory surgery centers, clinical laboratories, and physician offices. Lower, like I said, lower dividend yield and 22% buy rating, but 22% buy, 72% hold. And then here it kind of gives you bulls and bears explanation as to why it has whatever rating, but over $1 earnings per share quarter after quarter. So I wish I knew more about this, why it's down 39% in the past 5 years. But it does give pay a nice dividend. It actually increased its dividend here recently. So annual dividend yield of 3.67%, or $1.94 per year, paid quarterly, and has a dividend increase every year for the past 15 years, which is good. So overall, I think that this is probably my favorite, except for that declining 5-year stock price. But company-wise, I like what they do, and I also like HR. That was another one of my favorites. But for those of you looking to get into REITs. A lot of them are still down since coronavirus. Um, a lot of you looking to get into REITs, but I have also been specifically looking at healthcare REITs because I am exposed in my other account to um, other types of REITs that do just land, housing, and real estate. So I do not have any medical REITs exposure, and so I was just looking around at some of those and seeing what all was out there, and figured I'd pass along the five or top five that I found to you guys. So thanks for watching, and